Well, welcome everyone to the third session on day one of the Modern Investor Summit. I'm Theodora Lee Joseph, Global Markets Analyst at Finimize. Now, before we begin, I want to say thank you to our Global Summit partner, CFA Institute. CFA Institute is the global association of investment professionals that sets the standard for professional excellence and credentials. The organization is a champion of ethical behavior in investment markets and a respected source of knowledge in the global financial community. Their aim is to create an environment where investors' interests come first, markets function at their best, and economies grow. There are more than 190,000 CFA charter holders worldwide in 160 markets. CFA Institute has 9 offices worldwide and 160 local societies, which speaks to their global presence. Now, for those who are just tuning in, if you haven't already, please introduce yourself in a chat box with your name and where you're tuning in from. This will be a 20-minute discussion followed by 10 minutes of audience Q&A, so don't forget to ask your questions in the Q&A box below. Well, I'm joined today by 2 very special guests. We've got Chris Fiedler, who is the head of industry codes and standards at the CFA Institute, and Hardik Shah, who is an experienced ESG specialist with many years of practical experience in the field. Now, both my guests are here today because we'll be discussing the latest on how to analyze and value sustainable stocks, how to integrate ESG in your portfolio, and ways to help you become a smarter investor. Welcome both. Very excited to have you with us.
Thank you for having us, Theodora.
Thank you, Theodora.
Great. We're in a very exciting time when it comes to climate finance and sustainable investing. Well, the COP28 talks are happening as we speak, and there's been discussion if sustainable investing makes any sense now. If anything, if we look at ESG fund returns and flows in the last year, that might have placed some doubts in investors' mind. So this leads me to my first question, addressed to you maybe, Chris, and feel free to jump in, Hardik. We've seen the ESG landscape facing a lot of changes in both the US and Europe for different reasons. My first question is, how do you see these trends playing out over the next 5 years?
Well, thanks, Theodora. I think predicting the future can be a dangerous business, but I'm willing to give it a shot. When thinking about the future, I like to first look at the past to see where we've been. Let's go back to 2005, when the term ESG was coined in a United Nations paper called Who Cares, Who Wins? The main idea of that paper was that if companies were well governed and if they managed their environmental and social risks, that would be good for the company financially, but it would also have a good knock-on effect for the environment and society. That idea spread slowly but steadily, probably until 2012, and then it really took off. And by 2020, it was mainstream. In 2020, CFA Institute did a survey, and we found that 85% of investment professionals were incorporating ESG factors into their investment decisions. So at this point in 2023, I would say that we are in the late stages of growth with respect to the idea of ESG integration. And ESG integration relies very much on data. So we've also seen this similar growth trajectory in terms of ESG disclosure standards and regulations and ESG data services. In the later stages of growth, it's typical to see continued improvement, but at a slower pace. So I think we'll see continued evolution in disclosure regimes and continued improvement of the quality and quantity of ESG data. And I think this will go on another 5 years or so. And at some point, though, I think there's going to be a paradigm shift. I think people will start questioning whether all this data and disclosures is enough to get us to a low carbon economy. And as we approach 2030, I think there will be a growing acknowledgement that policymakers need to do more. And if and when that happens, I think the conversation in the investment industry will shift from ESG data to a growing focus on how policymakers are shaping entire industries and the landscape of international trade.
Maybe I'll add a couple of things here, Theodora. So definitely agree with, I think, Chris' comments here. I think there's a couple of areas where I see kind of the ESG landscape evolving. I think the first is historically investors have been looking at broad ESG metrics, so multiple environmental, social, and governance issues, and then kind of all rolled up into one single rating. Um, in the recent years, I'm seeing a shift from that to maybe focusing on specific ESG issues, be it climate change, be it human rights, the supply chain, and so on and so forth. So I think that trend is definitely likely to continue. And then the other thing I want to kind of point out is around using third-party data versus your own proprietary insights and metrics. I think that is something I think we'll definitely kind of pick more in detail as the session goes on. But I think I'm seeing a clear trend in the more mature investors shifting away from just simply relying on corporate disclosures or third-party ratings, but actually adding their own lenses and let's say insights before taking those investment decisions.
Right. I guess one point as well is one trend that we've seen as well is this whole idea of greenwashing. There is no one standardized metric that we use to say actually this is a sustainable company. And so lots of companies or institutions are tagging on labels that don't necessarily reflect the sustainability of your product or company. And on the back of that, are there any misconceptions or mistakes the investment community has made around the field of sustainable investing? And are things changing?
I'll take that one first. I think it's very important we start the conversation here with a common understanding of what sustainable investing is. Sustainable investing considers the risk and return of investments, but it also considers their sustainability. That is, the degree to which they meet the needs of the present without jeopardizing the needs of future generations to meet their own needs. It is distinct and different from ESG integration, which considers ESG factors in an investment process with the aim to improve risk-adjusted returns. And maybe the first mistake of the investment community is conflating those two different ideas, or maybe allowing them to be conflated by others. A second mistake might be thinking that sustainability can be reduced to a simple set of criteria that produces a binary decision about whether something is or is not sustainable. It's just a more complicated analysis than just that binary decision. So it's easy conceptually, but it's difficult in practice. And one reason it's difficult is the problem of definition. Does sustainable investing mean investing in assets that are already sustainable? Or does it mean investing to make assets more sustainable? Or can it be both? And how do you determine whether an asset is or is not sustainable? Where do you draw that line if there is really a distinct line? And second, there's the problem of measurement. Which of the many, many metrics should we use to evaluate sustainability? Who, where, and when should that data be reported? And how do you translate direct scientific measures like carbon emissions into an investment context where things are much less tangible? But I do see this changing. The industry is growing and evolving all the time. And for example, I was happy to see the sustainable disclosure regulation come out in the UK that has 4 different sustainability investing labels that reflect the different ways that investors can approach sustainable investing.
Yeah, I think from my side, I think a couple of things that I want to highlight here is, I think first, investors or predominantly asset managers kind of gave their clients an impression that portfolio impacts and real world impacts are one and the same thing. And that is not always the case. Like let's take an example of you investing your money in, let's say, a low carbon equities fund. What the asset manager is essentially doing here is tilting the portfolio towards companies that are more carbon efficient or relative to peers have lower carbon emissions. this does not necessarily mean that because of your investment, we are reducing carbon emissions in the world. You're just kind of providing capital, and in most cases, providing capital to in the secondary market to companies that are a little bit more carbon efficient. So these two are very different things, and that is something that I think the industry is guilty of not being very clear or transparent on. The other area is, and that's something that Theodora, you pointed out earlier, was around greenwashing, right? So with this huge kind of demand for ESG funds or sustainable funds, I think asset managers have also been guilty of quickly relabeling existing investment products as green or sustainable or ESG without sufficiently changing the way they kind of do their investment analysis and portfolio construction processes. So that is something that has kind of led to what I would kind of think as more temporary backlash. Like Chris was mentioning, UK as well as the EU have come out with various regulations to kind of stem or stop this greenwashing and in a way give more clarity to investors. So I think I'm positive that this will change the landscape towards the better in the next couple of years.
Yeah. Well, I think one thing that we can all agree on is that sustainability itself is a complex, term, and there are so many layers involved. As Chris, you said, it can't be reduced to a single set of matrix. So, I mean, on that hand, it's leading me thinking, as retail investors, if as a retail investor, if I want to invest sustainably, what do I have left to go with? What role do ESG metrics and sustainability ratings actually play in helping, identify promising investment opportunities? And how can I, as a retail investor, actually use these tools to help me in my decision-making process?
Well, I would say that there's many ways that investors could use ESG metrics and ratings, and the specifics depend on the strategy or the investor's objectives. For example, in a fundamental analysis strategy where the objective is to find the intrinsic value of a security, then I would say investors really need to look beyond aggregate ratings and identify the very specific ESG factors or pieces of data that are important to the valuation of the security. But in a quantitative strategy, it might be more important to look at ESG data that is consistent and available for the entire investment universe. When looking at ratings, it's very important for investors to understand the objective of the rating system. Some rating systems evaluate the ESG risks of companies and how well they're managed. And other rating systems evaluate the environmental and social impacts that companies have. And I've seen several cases where people have incorrectly, it's assumed one of those things when in fact it's the other. So Hardik, let me pass this over to you. You've got a lot of experience here. What would you say?
Sure, Chris. So I think maybe firstly, if we take the example of retail investors, right? So people like you and me trying to kind of invest their pensions and long-term savings into certain funds, I think it's important for you to kind of understand, and I'm just reiterating what Chris mentioned, is around what is your objective? Is your objective just managing risks? Then you'll have a different set of metrics that you look at. If your objective is maybe having a positive environmental impact or social impact or carbon impact, like it could be a variety of different things. That will kind of drive your kind of selection of metrics. One thing that has happened in the recent few years, which is good actually for retail investors, is you can actually compare sustainability metrics for funds. A lot of these rating providers like MSCI have put in their high level fund ratings in the public domain. So you don't need to kind of subscribe to some of these things. Coming back to as an investor, when you're evaluating a variety of ESG metrics, I think what's very important is how do you ascertain the financial materiality of some of these things, right? It will vary depending on the country the company is operating in, the sector it is operating in, and most importantly, what is your investment time horizon. So I think nobody today will disagree that climate risk is important and should be factored in. But if your time horizon is just, let's say, 3 months, then it may or may not impact your investments. But if your time horizon is 10 years, then and most certainly it will impact in some form your investment. So I think the time horizon aspect is very important that sometimes investors kind of forget. And we often talk about, when we talk about ESG, issues or ESG integration, we often talk about it in a risk context. I think one thing that we also need to understand is it's not always everything about risk. There are also opportunities. And when we talk about climate, for example, one thing is very clear, and I think some of the previous sessions when we are talking about mega trends, there it was also mentioned that the decarbonization of different industries and sectors across the world is a mega trend. So we know that the world is trying to move towards a low carbon future, and in that kind of transition you will see more demand for products and services in the climate mitigation space. So think about renewable energy producers, think about electric vehicles and battery manufacturers, and so on and so forth. But also, as global warming plays out, there will be a need for adaptation, right? So the world as we knew in the past may or may not exist. So we need to adapt to, let's say, warmer temperatures, sea level rise, and so on and so forth. So there are opportunities to invest in companies that are trying to find solutions for both climate mitigation and adaptation, and because there will be more and more demand for such products and services.
Thanks very much, Hadik. That was very interesting. I think I definitely agree with you about knowing your objectives, your time horizon before you invest in anything. But I just want to step back a little before we dive into the interesting part about opportunities you talked about. I think there's this negative stereotype that when people think about sustainable investing, you think about risk management as opposed to opportunities. And so I guess the question is, if I'm comparing sustainable investing with traditional investing, like just investing in anything purely for returns, what are the unique factors that one ought to consider in doing so?
Sure. So I think when you talk about sustainable investing, you are not only trying to manage risk and get the most returns, but there is an additional objective of maybe lower carbon emissions, or maybe having more diversity in the companies that you invest in. So there are I would say more than one objectives, and these may or may not align at times. So I think that is something that the investors need to keep in mind. Uh, it might be a situation where your financial objective and your sustainability objective are actually at conflict, and then I think you need to take that decision on, okay, which one is more important for me as an investor, and that answer will differ from person to person as well as from asset owner to asset owner. Just take a quick example, like if your sustainability goal is actually preserving biodiversity, but the company that you are trying to invest in is operating in a country where environmental laws are not strictly enforced. So for that company, it's cheaper for them to release, let's say, wastewater in the nearby stream without adequately treating it, because in that scenario they reduce costs and hence are more profitable. But because of doing that, your biodiversity in the region is actually negatively impacted. So that's one good example of how these two goals could be in conflicts. And in that situation, you need to kind of define your tolerance level, your threshold. So sometimes even if you think about sin sectors, right, tobacco, alcohol, a lot of times investors say, I don't want anything to do with that in my portfolio. And other times the investors might say, I don't want this to be the main revenue stream. So if it's, let's say, 10% of the revenue for the company, I'm fine. But if it's more than that, I'm not fine. So I think these are some of the things that investors should keep in mind. One last point, and before we kind of hear from Chris as well, when you talk about using different metrics, there are, like, I would say, some quantifiable ESG issues, and then there are other issues which are, let's say, more qualitative in nature. So I think investors also need to keep in mind that not everything is quantifiable, and maybe if it is quantifiable, it's not necessarily insightful, right? So you could mix a lot of different scores and create a overall ESG score, but is that giving you any sort of information? So the more popular metrics that I'm seeing investors kind of look at are carbon intensity. So how much tons of CO2 or carbon emissions a company emits per $1 million of sale. Things like lost time injury rates. So if at a workplace, 1 million hours of worker hours are put in, how many injuries are kind of happening, and so on and so forth. So I think more than identifying the metrics. What is important is identifying the link of from that to the financial materiality, right? So if a company's carbon intensity is high, how will that play out, and what time horizon, and so on and so forth. So maybe over to Chris to kind of hear his thoughts as well.
Those are great comments, Hardik. I would add that companies don't operate in isolation. They operate within a system, natural ecosystems within society, within financial capital markets. And I think the value of ESG analysis is to put that sort of systems thinking lens on the company and think about what are those relationships between the company and the environments or ecosystems that they're operating in. And that's a two-way interaction where those environments will have impacts on the company and the company will have impacts on those environments, and they can be both positive and negative. And it can be at a micro level and it can be at a macro level. So I think ESG is really a way of expanding your view and looking more holistically at investment opportunities.
Fantastic. I think it brings me to the next question, which is I guess really important, because we know that investing doesn't take place in a vacuum, particularly ESG and sustainable investing. What we are facing today with higher rates, higher inflation, and the risk of a recession on the horizon, how do you think that's likely to affect or change how people think or invest sustainably?
I think the current macroeconomic environment will probably have some minor effect in the short term, but not a significant effect in the long term. At least in some markets right now, we're seeing some outflows that are likely the result of returns chasing, probably some risk management as investors seek safer assets in the face of economic headwinds. But these short-term trends, I think, are offset by sustainable investors' long-term commitment and their commitment to sustainability. The most recent Global Sustainable Investment Review, which was published in September by the Global Sustainable Investment Alliance, reported that there was a 20% growth in non-US sustainable assets under management. In the US, they changed their methodology, so the results probably aren't as comparable there. But those data points lead me to believe that investor interest in sustainable investing does remain strong, and that sustainable investors will continue to represent a significant segment of in the foreseeable future. What do you think, Hardik?
Yeah, I would also agree. I think what we are seeing very clearly is some of these ESG issues playing out in the short term. So it's no longer something that you worry about your children and grandchildren. You're seeing the ill effects of some of these issues like climate playing out in our own lifetime. So I would say if nothing, I think you'll see more and more integration and mainstreaming of ESG topics. And again, I stress on the word topics and not the broad ESG ratings or metrics, because it will be specific issues that investors will be more and more concerned about. But I don't see this kind of setback, or I don't see ESG as a short-term fad or trend. I think it's here to stay. I think we just keep evolving and fine-tuning our application of how we kind of do this and influence our investment decisions, which is I think similar with any new field. As your knowledge improves, as data improves, you will keep on changing and fine-tuning the way you kind of implement it.
Great. Yeah, and I think if you're thinking about investing sustainably, it's going to be a long-term kind of you're going to have a long-term a view, because change is not going to happen in a short while. Which leads me to kind of my last question, because I've seen an interesting question from the audience that I want to end off with. I guess, do you have any practical tips for investors if they are thinking about integrating ESG in their portfolios? That's part one of my question. And then the second question is, are there specific sectors, regions, or geographic areas where you're seeing very interesting sustainable investment opportunities?
Maybe I can kick that off. So I think ESG issues are fairly broad. You need to pick what matters to you. to be kind of be able to kind of focus, right? So you can't just say, I just want a highly ESG rated fund. I mean, that could be an outcome, but really you're not necessarily impacting a lot of different things. So I think first figure out what is it that you want to have a positive impact on, and find the right metrics. So that is definitely number one. Number two is defining thresholds, right? So company behavior is not static. You might choose, let's say, for the sake of argument, a AAA rated company today in your portfolio, which is basically best in class from an ESG perspective. But for whatever reason, they might have a controversy in a year later. So what do you kind of do in that scenario? Do you sell it off? Do you maybe evaluate whether this was one off or is this a systemic issue, and then kind of take a decision? So I think defining thresholds, as I was saying earlier, what is allowed, what is definitely a no-go, is the second part. And then I think the third part I would kind of talk about is try and uh, look at it from an opportunity perspective as well. It's not just about risk management. There are definitely, I think, secular growth opportunities, as I was mentioning earlier, in the climate mitigation, climate adaptation space, and that is something that you should also keep an eye on, in addition to artificial intelligence and some of the other things that are in demand and kind of the buzzwords today.
My practical tip would be do your due diligence. There's a lot of data out there, but there are still data quality issues. And so it's important to understand the source of the data that you're using and the quality of that data, and to thoroughly investigate companies and investment opportunities before you invest.
Great. And are there specific sectors, regions, geographic areas where you see very interesting opportunities?
I think from my perspective, I would say in the decarbonization space, that will be the biggest opportunity. So think of energy sector, utilities. That is, I think, going to be the big focus area. So the shift from fossil fuel-based power generation to, say, renewable power generation, I think to me is one of the biggest opportunities. So, and it's not just the power generation itself, but the allied infrastructure, right? So smart grids and so on and so forth.
Great. I think we might have time to squeeze in one audience question, and I think it's very relevant now with COP28 happening. It's a question from Jalen, and it's asking, how will the outcomes derived from the recent COP28, how do you think that will affect decisions or cause a paradigm shift in the global economy from your perspective?
Maybe I can take that first. So COP28 is still ongoing. I feel, given what I'm hearing from the COP this year, is people are very determined in terms of this is not just a COP where you kind of pledge and like create policies and things like that. You want to kind of start seeing some action. So I think the initial days have been positive. You are seeing more and more kind of I would say real world action versus just promises. That has been the case in the past COP. So I'm at least at the moment, I'm a little positive and optimistic around the COP being kind of a driver of, or it's in some ways accelerating action around climate and decarbonization. And I think what's very important is also not to forget the transition part of it, right? We've talked about all of this about going green and so on and so forth, but there is a need to also transition existing sectors which are more difficult. So think about steel, cement, and so on and so forth. Help them kind of decarbonize at a healthier pace, so that we are not left with kind of just focusing on windmills and solar panels, but also transitioning the existing sectors.
Yeah, that's such a good point. The rate of change, managing the rate of change needs to be sustainable as well. With that said, I'm afraid that's all the time we have for this session. Thank you so much, Chris and Hardik, for taking time and sharing your brilliant insights. And thank you to you all for tuning in as well. I hope you enjoyed it and can take something away from this session. Now, don't go anywhere, as Uncovering Hidden Market Opportunities with Steven Trajet from Oakley Capital is up next. It starts in 15 minutes at 3:30 GMT. See you at the next session and have a great day.